Ever wondered why the best-laid plans often go awry? Let's take a stroll down the unpredictable path of life and business. You see, planning is vital. It's the compass guiding us through the dense forest of uncertainty. But here's the catch. Life is an adept improviser and doesn't always dance to our tunes. Picture this. A company meticulously crafts a business strategy, envisioning every possible scenario. But then, out of the blue, the market shifts dramatically, and their master plan crumbles like a house of cards. It's not because the plan was faulty, but rather because it was mostly right in a situation that demanded absolute precision. The essence of planning isn't about predicting every twist and turn, it's about acknowledging that the road ahead is dimly lit, full of unexpected turns. The truth is, a plan is only as good as its ability to survive reality. So how do we navigate this sea of unknowns? Well, the first step is to acknowledge that uncertainty is not our enemy, but rather an integral part of the reality we operate in. When we build our plans, we must construct them with the understanding that they will meet reality, a reality filled with unknowns. This is where the concept of a margin of safety comes into play. The margin of safety is a buffer, a cushion against the uncertainties of the future. It's like an investor who doesn't put all their money in one stock, but spreads it across a diverse portfolio. They're not predicting which stock will soar or plummet, they're simply creating room for market fluctuations, for the ups and downs that are a natural part of the investment landscape. This is the essence of embracing uncertainty. The margin of safety is not about avoiding risk, but about increasing your odds of success despite the risk. But just how powerful is this margin of safety really? Think about it this way. You're a business owner who has meticulously planned for every possible outcome. You've calculated your risks, you've set your targets, and you're confident in your strategy. But then, an unexpected financial crisis hits. Businesses all around you are failing, but you survive. Why? Because you had a margin of safety in your plan. This buffer didn't just protect you, it gave you the flexibility to navigate the crisis. Many businesses fail not because their plans were wrong, but because they required things to be exactly right. That's a risky proposition in a world filled with unknowns. Consider an aircraft engineer. They don't design a plane to fly at its maximum capacity all the time. They build in a margin of safety to account for turbulence, unexpected weather, or mechanical issues. It's not about being conservative, it's about raising the odds of success and increasing your chances of survival. The margin of safety is one of the most underappreciated forces in finance. So, how do we build a plan that can survive the reality of the unknown? Well, it starts with building in a margin of safety. This means not just acknowledging the possibility of things going awry, but actively planning for it. It's about expanding our idea of what's probable and allowing for flexibility and adaptability. Consider the story of a successful risk manager. Rather than banking on a single outcome, she always plans for various scenarios. She doesn't just say, if A happens, then B will follow. Instead, she says, if A happens, B might follow, but so could C, D, or E. And if B doesn't happen, we've got plans for C, D, and E. That's the essence of planning for reality. It's about understanding that the world doesn't owe us anything. The more we can plan for different outcomes, the less likely we are to be caught off guard. Remember, the most important plan of every plan is to plan on the plan not going according to plan.